as Graham mentioned, my name is Ryan Coon. I was one of the co-founders, the CEO of Avail. Avail was and still is a Chicago-based company that really strives to make the rental experience better for independent, non-institutional, what we call DIY landlords, and for their renters. And what I mean by a DIY, a do-it-yourself landlord, is really all the men and women like us on this call who are often busy professionals, entrepreneurs, small business owners, and maybe own a couple rental properties on the side. So we're not talking about the big apartment communities. We're really talking about the mom and pop landlord. I got into this, a bit about me and my background. Originally grew up in the Chicagoland area, studied accounting and finance, worked for a large investment bank for a number of years. And then along that journey, had acquired a couple of rental properties. And I was a busy professional. I was working crazy hours in banking. And I was also managing a couple of rental properties on the side. And I was managing my properties with a combination of spreadsheets, pen and paper, paper checks, text messages, and ultimately found that that was really inefficient for me as the owner, and often led to a poor experience for the people renting the properties. And so one just quick story to illustrate this. So I know we're already in September, but we just came off a really brutally hot August here in August. And it made me remember one of the times that I unfortunately let my tenants down, basically because I was managing properties with a text message, was back in 2011. I happened to be in Boston for a work meeting late in the week. I was flying out of Logan, coming back to Chicago, and I happened to miss a text message from my tenants that the air conditioning had gone out. And if you know anything about Chicago in August, it's hot, it's humid, and the one thing you don't want to have happen is your air conditioning goes out. And so I'm not a slumlord. I felt awful about missing this text message. And ultimately I started thinking, there's got to be a better way for people to manage rentals. And so started thinking about this idea, this concept that would become Avail. Spent a lot of time looking at the US Census data, really to try and size the market. And what I found was that actually about half, so 1/2 of all rental properties here in the country are owned and self-managed by DIY landlords. And that to me really was a signal that this is, number one, a big problem for me, but there's a lot of other me's out there who are having this problem. And so with that bit of knowledge, I decided, I want to pursue this. I've had enough with banking. I've stopped learning. I've stopped growing in what I'm doing day to day. And I left banking. I actually enrolled in a really, at that time, early stage coding boot camp. So this is back in 2012. This was way before boot camps were kind of all the rage. But I spent 3 months really learning Ruby on Rails. I did that not with the ultimate goal of writing code for a living, and not writing code to build the entire product. Although part of that happened, but I really wanted to be able to be fluent in how software engineers spoke. And I wanted to be able to understand what they were doing. And so went through that experience. While in that boot camp, I convinced my co-founder, Lawrence, who was a good friend. He was at Goldman Sachs at the time, convinced him to leave Goldman. And we just started, the two of us, writing code. And we spent about 1.5 years kind of building the product, building the technology, We made some mistakes along the way. I would say the biggest was we didn't talk to enough customers early on. There's a couple of kind of tech and product things I can explain later that really illustrate that. But we, after a lot of blood, sweat, and tears, like we had cobbled together the MVP of our product, and we launched it. And we started getting our friends and family to use the product. We got some early feedback. We iterated on it. And then we were somewhat in this situation targeting these independent landlords, and we had to figure out a really good, efficient way to go out and find them. And so we started writing content, really, really thorough educational content for landlords and renters. And slowly people started finding us and started finding our product. We put some dollars behind paid search and paid media, tried to figure out what our unit economics looked like. And then in early 2015, we were lucky. We raised a little bit of outside money from really friends and family and angels. We went through an accelerator program out in New York called MetaProp. That was a great experience and great program for us. And then we just kept building. And by early 2017, we had reached almost $1 million of ARR. And we started going down the path and thinking, you know, we should raise maybe a little more money to put a little more fuel on the fire. And that's around the time I met Graham, and was fortunate that Graham saw the vision of what we were building. And we were able to get connected with the great team at Cultivation, who ended up leading a round for us that year. And then along the way, we just kept iterating on the product. We kept refining our marketing. We had built several partnerships with others in the industry. And so we just kept building. And we raised a couple more rounds of venture capital. The most recent was a little over a year ago. We raised a $5 million round of funding during the pandemic. And that funding was a combination of debt and equity. So most early stage companies will just sell equity in the company. We had reached a point in our company's journey. We were able to get some debt financing, which was great because the debt was non-dilutive, which means that we weren't giving up ownership. We were just paying interest, just like you would on any other loan. And then about a little over a year ago, around the time that we were raising that round of funding, we had been approached by one potential acquirer of the company. They're not the one that ultimately ended up buying the company, but it was a large financial services firm. We showed up to the first diligence call with them, and they had about 40 people on the call. And at the time, we had about 35 people on our team. And so we were well outnumbered. I think it was just Lawrence and me on that call with these 35 people, or sorry, the 40 people from this firm asking us questions. And by the end of last summer, we felt like things were getting close with that group. We started talking with a few others, including Realtor.com. Realtor.com quickly emerged as kind of the preferred buyer for the company. We, at the time with Avail, we had 4 core values as a company, and Realtor had 4 core values, and they were almost the exact same. And the team at Realtor was fairly new. For a company that had been around 25 years, Realtor had had some turnover in their executive ranks. They had just brought on a new CEO. who had previously run the marketing team at Expedia, was the head of growth at eBay. And David joined the team last year and immediately started pushing for more of a presence in rentals. And so little to my knowledge that at the time that we were going through our own acquisition process, Realtor was also doing their own scan of the market and had commissioned a study with one of the big consulting firms that ultimately led to them recommending you, Realtor, should go out and acquire Avail. And so it was very, very kind of serendipitous how things came together. But at the end of last year, on December 15th, I was standing here in my home office, which is a second kind of spare bedroom in our condo here in Chicago. On the afternoon of December 15th, I was standing here literally wearing slippers and called an all hands team meeting with our team and announced to our 45 people at the time that our company had just been acquired. And as an entrepreneur who had spent years building a company, I can share that there's nothing more exciting, fulfilling, rewarding than kind of going through that experience. After we closed the deal and all the papers were signed and everything that morning, Lawrence and I quickly pivoted to thinking about how do we grow the rentals business here at Realtor. You know, Realtor.com is a very well-known name in the real estate space. But they hadn't really invested in the rentals category. And so that's where Lawrence and I came on really to lead the business. I think in hindsight did the right thing though, and we almost consciously said, let's put that work on hold for a little bit. And instead what we did is we focused on making sure our team was set up for success. And so we spent the first 4 to 5 months of this year focusing on our team, making sure that everyone was feeling welcomed, they were connected, they were still engaged with the work. I'm really proud of the fact that even through today and September 2nd, we've only had 2 people out of those 45 people have left our team now. And so if you've ever gone through an acquisition, you know that typically after a big transaction, there can be a lot of turnover. Really proud of the fact that we've only lost 2 out of 45 people. And so that was the first 4 to 5 months of my year, was setting the team up for success. Then David came to me in, I'd say it was end of April, early May, and asked me to lead the rentals business for all of Realtor. And so what that encompasses is continuing to think about the DIY landlords that we had at Avail, but also thinking more broadly about the renter search experience and thinking about how do we engage and work with those bigger institutional owners. And so have been spending the past few months doing that. We're having a lot of fun doing it. The business is growing like crazy. Our traffic to our rentals site is up significantly year over year. We're continuing to deliver value to all of our partners. And most importantly, we continue putting the renter and the consumer first. The other thing that we've been doing a little bit of that I think is unique, we've been asked over the past year to share more of our rental data with different, call them government officials and policymakers across the country, and including the White House. And so we're now providing frequent updates to the Treasury Department, the Housing and Urban Development Department, and a lot of the economists in the administration will now look to us for information, real-time information on how landlords and renters are faring during the pandemic. So I'd say that's it on the professional side. Happy to answer any questions around anything I just covered. And then the one other kind of bit that Graham asked me to touch on is, since we were fortunate to sell the company back in December, I've been trying to get more involved as an angel investor on the side. Definitely don't spend a lot of time on this, but I think it's really important for me and for other founders, other entrepreneurs who've had some success to really give back. And I'm excited to have made about a dozen angel investments to date yet this year. And so I'm always excited to connect with entrepreneurs, figure out how I can either help them, invest alongside them, connect them to a vast network of people in the community. And so really happy to share more on that. Happy to answer any questions on the investing side, the realtor, the Avail story, or to provide insights and share experiences on anything that could be helpful.
I love the story. It looks like we already have some hands being raised up here on stage. I see Jonathan and Tony. Welcome. Jonathan?
Hey Ryan. So I have a question about the investing. And you mentioned that you are doing like an angel investment since in the last few years, and wanted to check like how you decide you have like an industry that you're focusing on, or if it's like in real estate, or it's more spread and you have other markets that you are interested.
Yeah, good question, Jonathan. For me, and I guess part of what I should share is because of my position now at Realtor.com, and because of all of that, there's certain limitations on real estate companies that I'm able to invest in. And so what I'd say is I'm broadly interested in fintech. I think there's a lot of exciting innovation going on in how people manage their finances, how money is transacted and moved. I also am a big proponent of anything. I would say anything that is really focused on helping businesses acquire customers is another area that I think is really interesting. And then broadly speaking, I think part of my philosophy too is to get involved really early with companies and to try and make a lot of smaller bets as opposed to trying to pick winners. So I'm by no means an expert, and I don't think I would frankly be very good at trying to pick the winners. So tend to spread bets across a lot of different companies.
Got it. Thank you.
Awesome. Appreciate having you up here, Jonathan. And we'll pass it over to Tony. Tony, welcome.
Hey, thanks. Can you hear me all right?
Yeah.
Yep.
Oh, that's awesome. So my question, I had actually, we're a white label self-service company. We provide a distributed white label capabilities for platforms as part of our product suite. And we'd been working with Realtor, and it got a little in the backtrack. And I think a lot of it, they might have been looking for a little bit more adoption. Can you talk a little bit more about what happened with Avail in terms of where you were in the marketplace in terms of adoption, in terms of adoption across the board, and what that meant in terms of acquisition by realtor, or was it just that they just really needed some tool sets and not necessarily penetration? Thank you.
Yeah, Tony, great question. And happy to connect offline, and I can maybe try and help chase down kind of what happened.
Right.
In terms of traction and adoption, Avail was, and I think still is, one of a handful of companies that operate in the DIY landlord space. There's areas that I think were better, areas that I think were, that I admire some of our competitors. I think when we were acquired, and kind of knowing part of what I know now, I think we were acquired really, I would say, for 3 things. And I would say that this is common for most, maybe not most, I can't really say that, but a lot of acquisitions, I'd say, there's one over a combination of 3 drivers, where it's really the technology, the capabilities, the tools, the product that are being acquired. So that's number 1. Number 2 is maybe a customer base. And last year when we were acquired, I want to say we had about 20,000 kind of active revenue generating landlords using the product. And so sometimes companies will acquire another company for its user base or customer base. And then number 3, I think, and this is an area that I think we were really strong in, was the team. And so I think when Realtor was looking at us, I think they saw a really strong team of people that had been around a while. I don't know yet. I haven't gone back and like asked what that breakdown was when they were doing their internal analysis. But I think, at least in our case, and from what I've been told, Realtor acquired us for a mix of all 3 of those.
Thank you.
Yeah,
that's great. Yeah, that makes total sense. Yeah, it's just like combination.
Yeah,
sure. Thank you.
Yeah,
so
feel
much.
free to shoot me an email, Ryan@avail.co.
Ryan@avail.co. Okay, great. Nice connecting.
Yeah.
I could ask one follow-up unless anybody else.
Yeah, go ahead.
What's next with doorsteps, or is it
yeah, good question on doorsteps. For those who may be listening that aren't as familiar, so doorsteps is a URL. It's a company, I guess you could call it, that's owned by Realtor.com. Doorsteps was really started and spun up about 7 years ago, really to be more of a younger, urban focused rental platform. Like a lot of things in the rental space at Realtor, it never really got as much investment and love as it should have. Doorsteps is one of the call it products now that is in my portfolio. And so as of now, Doorsteps is continuing to drive renter traffic, and I think and I hope that we're continuing to drive and help renters ultimately find home through Doorsteps. And so we're still in the process of figuring out where do different brands sit, if I'm being very transparent. But I think that's definitely a part of our portfolio that we think could be a big growth driver.
It's a great domain for sure, and I like the branding. Anyway, thank you.
Yeah, thank you, Tony.
Thanks for popping up, Tony. Now we have Noam. Noam, welcome.
Thank you, and good pronunciation on my name. It's people stumble there. Ryan, I just want to say thank you first for taking the time, making yourself so available. I really appreciate hearing your story. And I remember reading when Avail got acquired and sharing it with my team. We're building also a startup in the rentals prop tech section. So it felt like whenever you see a rentals company succeed, it's like a win for us all. So I wanted to ask you, you mentioned how you guys are focused on, or your Avail was working on the renters and then the landlords. Where do you see the rental agent in the prop tech ecosystem? Because I was a real estate agent for about 10 years, focused on rentals. That's kind of where our startup is focused on. And I'm wondering, from your perspective, like where do you position or what value do you put on the actual agents who are focused on rentals in prop tech?
Yeah, that's a great question. And I appreciate you sharing, and it's great connecting with another entrepreneur building in the rentals space.
Sure.
As I think about the agent, so the first thing that I'll say is I think agents have a lot of value in a lot of situations. I also think that some geographies are, for one reason or another, maybe agents play a bigger role. And so like New York and Boston, it's much more common for agents to be involved in the transaction. Where I ultimately kind of believe on this is I think the consumer should have choice and should have options. And what we really focus on with Realtor and Avail is making the most choices available. And so what I mean by that is, again, there's a lot of transactions and a lot of leasing transactions where brokers provide immense value to either the landlord who's looking to fill a vacant unit or to the renter who's maybe moving from another city, doesn't know the neighborhoods, and needs that almost Sherpa or that helping hand to guide them through making a decision on where to live for the next 12 months. I also do think that there's some situations where landlords are able to connect. They're fully capable of going out and showing units, following all the fair housing guidelines, and doing that themselves. Mm-hmm. And so I ultimately truly think it should be driven by what each party needs. The other thing I'd say on this topic, and I'm not sure if it was in there, is kind of a what are we doing? What are we doing as Realtor in this space? And the honest answer is we're not doing as much as I'd like for us to be doing right now. Mm-hmm. In fact, earlier today I was trading emails with the head of kind of industry relations at Realtor, who oversees and has a lot of the different relationships with MLSs. And we do hear from time to time how much, I'll say it nicely, opportunity there is for technology to help agents. And so if that's a space that you're building in, at least the feedback that we're getting and the questions that we're getting imply that it's a big space with a lot of opportunity. So
yeah.
No, that's a great, and I don't want to take everyone else's time, but I would love, if possible, to connect with you offline just to talk shop more about the rentals and prop tech and a little bit more of what we're, kind of follow up on what you were just talking about there.
Yeah. Again, my email is ryan@avail.co. I'll make sure that we get that shared afterwards too.
Thank you.
Awesome. Thank you so much for coming up, Noah. I love the vibe up here. If anyone else does have any other questions for Ryan, you can hit the little raise hand button down at the bottom, and then I can bring you up on stage. I actually have a question more geared towards Graham. For anyone who came in late, Graham actually, his firm, he's at Cultivation Capital, invested in Ryan in both the seed and Series A rounds. Why? What were the things whenever Ryan was pitching to you at that seed stage that you were like, yes? I'm super interested.
Yeah, I mean, that's definitely a great question, Ryan. And Ryan Coon, feel free to add on to this answer because, you can be a contributor too. But I think, from our team's evaluation standpoint, it was very much about Ryan and his team, even though they were early, having a deep understanding of the market. Ryan and Lawrence could both personally identify, as they or their families had been landlords, with the problem. They understood it well. We appreciated the careful approach that they took in learning tech first before hiring outside developers. The right stage of traction for us, as Ryan was saying earlier, they were, right around or maybe approaching $1 million in ARR. Our typical investment range, although we've gone higher and lower, but our typical investment range for a first investment at Cultivation is usually when a company has about $500,000 to $1 million of ARR. That's the traction we look for. Growth rate maybe was a little less, but it was in the range that we target as well, because we look at month over month growth targets as a part of our, kind of trajectory. Had a deep understanding of the market in which they were playing and the unit economics that they could use to go establish more customers. If we spend X dollars on marketing, it is very likely we will get Y new customers. At least as it stands now, that would produce Z in lifetime value. They had deep understanding of those kinds of economics. And in fact, I sat on Ryan's board for the entire time from the first investment until their exit, and we continued to review those metrics at least once a quarter at the board, all the way up to the board level throughout that whole time. And so we, had deep discussions about if we spend more on acquisition, the cost may go up, but if the LTV has gone up because we have more products and services and better ways to convert, then maybe it's worth it. What's the payback period? LTV to CAC ratio kind of thing. CAC to LTV. But anyway, but yeah, I think that's the short or maybe medium length answer is they were in the right traction stage, had the right growth. We appreciated the relationship we started to build with Ryan and Lawrence. And as we got to know them better, the rest of their team, and they had a deep understanding of their unit economics. I think those were the primary drivers for us. We think of ourselves probably not as the most, but as relatively disciplined investors. And so those were kind of the boxes we checked initially, beyond other legal and technical due diligence and things. So Ryan Coon, is there anything you want to add to that answer about when we initially invested? And I think it's okay to disclose this. We led their last 3 rounds before exit, actually. So.
Yeah, Graham, I appreciate that. And I think the only thing that I would add on there is that there were a couple of partners at Cultivation who had previously been in not kind of in the real estate space, but an adjacent mortgage space. And so they understood immediately the problem that we were solving. I remember that first pitch meeting down in St. Louis, sitting in that conference room, and these guys, it immediately resonated. They got it. And so I think one of the takeaways should be for other entrepreneurs, you really want to focus on getting investors and targeting investors who understand the problem that you're trying to solve and understand the space. I think a lot of entrepreneurs, and I know from time to time I fell kind of victim to this is you try and go out and meet with every investor that you can get in front of. And the reality is that a lot of that's going to be wasted time. Because if you're not more targeted in your approach, you're going to just spin your wheels. So that's the only other thing I would add, Graham. But yeah, appreciate it.
Yeah, you're absolutely right. And in fact, even another partner or two had previously had woes because of the processes they had used to manage rental units of their own. So we had a partnership team who fortunately understood the problem in a deep way. I guess I would say, maybe to go a little further and maybe to ask you a question back, Ryan, but I think it's also important for the entrepreneur and founding team to understand why these venture investors are the right ones. So maybe the flip side of the same question is, Ryan, why did you choose to go with us? And maybe it was because we proposed fair terms at the right time, and it can be that simple of an answer, but it may be helpful for folks here for you to talk about that as well as the process. I know Ryan conducted, at least that has been tracked in a detailed way, Ryan conducted before the raising of his last round that he referenced that was about $5 million, which we also ended up leading, although that was not our original intention. Ryan conducted, I believe, the most thorough tracked search of venture and talked to more firms than any CEO we have ever had in our portfolio, at least that we're aware of. And Ryan, you talked to, again, I assume this is fine to say, you probably talked to 140 some, you may still know the exact number and have PTSD from it, but you talked to, I think, about 140 VCs about leading that last round. We had already committed to participate. We just wanted some other, partners around the table and ended up leading the round. But maybe talk about why you chose us, and then talk about your fundraise process in the last 3 rounds, the last one in particular, and kind of the pains you went through.
Yeah, great question, Graham. So I think as a founder, you need to be, I'd say, honest with yourself about, and self-aware enough to know what you're looking for in an investor. And what I mean by that is there's probably a lot of different, you can probably go Google this, and I'm sure it exists out there, but I'd think about different dimensions where investors can either be very hands-off, or they can be very hands-on, or they can be kind of, quote, smart money that's there when you need them, or you can get dumb money from people who will never really contribute and add value. And I think the big takeaway, I think, is you've got to be honest with yourself about who you want. And so when we worked with Cultivation and we started working with them back in 2017, again, Lawrence and I, we were first-time founders. And we weren't even technology folks by trade, right? We had kind of both been in finance and real estate, and then learned to code. And so this world was entirely new to us. And so when we were going through that process of raising capital, I think what we were striving for is working with, number one, and I would say most important to us on our list, was people that we wanted to work with. When you go enter into that type of partnership with an investor, it's going to be a years-long endeavor. I think that, I mean, us going from kind of first check to exit in 4 years, that's probably relatively short for venture. And so we just wanted to work with good people, was most important. Number two, we wanted and we valued people who had done it before and built businesses. And so in addition to Graham, the other person who was on our board had built a company and sold it. And so it was important for Lawrence and me to be surrounded by people who had done that and could help us see around corners and understand what mistakes we could possibly make, and help us avoid those before we made them. Yeah, and then I think there's some amount of luck and serendipity and right place at the right time, and ultimately for us, and I'm grateful for it, like things worked out really well. Graham, I think on kind of your last your other question around like talk through the last fundraise. So what I can share is end of 2019 and going into 2020, we were beginning to think about another fundraise. And for any founder on the line, you can read between the lines and you know what that means. It means that we're running low on cash, right? We're getting to a point where, okay, if we wanted to continue growing the business and keep reinvesting, we're going to need to raise more capital. And so through relationships that we had built and through introductions from our investors, we went out and we met with literally almost 150 different investors. I was just racking up the frequent flyer miles last winter, and was back and forth all over the Midwest, on both coasts. And actually funny sad story was in San Francisco on March 10th last year, and ended up that was the day, I believe it was a Wednesday, that was the day that the NBA canceled their first games, and that was the day that Trump did his Oval Office speech. And I vividly remember having lunch with a VC that day, thinking that we were getting close to kind of finding a lead investor, and flew back to Chicago that night. I watched the Trump speech on the plane, landed in Chicago, emailed our team or Slacked them at midnight that night and said, we're going remote. And so pretty quickly then stuff got real, and it became clear that we weren't going to raise capital from an outside investor. And so what we did in March then is we pretty quickly said, look, we're going to dial down our marketing investments. We're going to hope that our customers stay with us and that we can continue making payroll. And what happened was fairly remarkable. And I think part of how we had grown the company was always watching that, what was our cash burn each month relative to marketing. And what ended up happening was we kept growing even though we had turned off marketing, and we had a few consecutive months of profitability that were completely unplanned. And so going into kind of May, June last year, we had been profitable a couple of months. We were still growing, albeit not at the same pace. And we ended up getting venture debt lined up. And then ultimately, the guys at Cultivation decided, look, we'll lead this round. And it came together pretty quick thereafter. So, and I think ultimately, raising that capital last summer then put us in a really good position going into M&A discussions, because we were in a position where we didn't have to do anything. Like if the terms made sense and they were good for everyone involved, we would do it, but we certainly didn't go into those negotiations needing to do anything. So, Graham, sorry, I know a little bit long-winded, but hopefully that.
No. I think that's really great perspective, Ryan. You know, and I guess what I would add to that is, you know, that for most people, you know, I mean, you got to realize venture funds in general are looking at between 100 and 1,000 is the general range companies before they make an investment. So you're going to hear no. And I think it's really helpful for any entrepreneurs out there listening to hear the story of Ryan, who, again, to our knowledge of all of our existing portcos, took the most disciplined approach ever and met with more funds. And although maybe some of them ended up participating in the round, basically got told no about 150 out of 150 times. And this is a growing, break even to slightly profitable company with several million at that point in ARR. So I guess the message is just hang in there and be tough. You're going to get told no a lot, and that doesn't mean anything bad about your company. And Ryan ended up with a very, very successful exit. So I guess my message in wanting people to hear that, Ryan, was just about them on resiliency, and that you can absolutely still have a very positive exit, as you proved about 6 months after eventually closing that round, give or take. So well, with that, I know we're getting close to the top of the hour, but does anybody else have any other questions? If you do, you can just raise your hand or put it in chat. I think Ryan Solomon is monitoring the chat. I'm actually not looking at it, but yeah, you can either raise your hand or we could wrap up a few minutes early if nobody else has any questions. Ryan Coon, thank you so much for sharing your story with us, of course. Oh, go ahead, Ryan. Sorry.
Yeah, I was going to ask a little bit about the acquisition, because I think that's something that you said you were a first-time founder, that founders don't really know about until they get there. I mean, that makes sense, obviously. But what kind of advice would you give to a founder who is, you know, maybe they're trying to build something and they're like, I want to build this to get acquired, or they're currently have a startup, they raise Series A, Series B, and they're in that actual position to where maybe bigger companies are reaching out to them. And one last question to that point: did Realtor reach out to you, or did you reach out to Realtor?
Yeah, a lot of really good questions in there, Ryan. So let me first start at kind of how the relationship came about and the outreach, and then I can talk through maybe some of the tactical kind of things in the process. Along the way, building the company, Lawrence and I and our team, like, we made countless mistakes and we screwed up a lot. One of the few things that we got right, I would say, is in the background, in addition to running the company day to day, what we were doing is we had built up a Rolodex of potential acquirers. And we were pretty thoughtful in getting to know I think we had a list of 10 to 12, 10 to 15 companies that we thought could possibly acquire Avail at some point. And we were pretty methodical about getting to know people at those companies, staying in touch with them, building a relationship, in some cases, developing a partnership with them. And so when the time came last summer, that we were in this process with another company, a big financial services firm, and we were getting close to getting a term sheet from them, what we were able to do is go back to that list of 10 to 15 names. And we went out to all 10 to 15 and almost ran a mini process. And we were able to reach out and say, look, we're going through this process. We think we'll expect a term sheet here in the next 2 weeks. And if you're interested in learning more and potentially maybe acquiring the company, let's talk. And so, Sally, I think to your question, when we were in that position that we thought we were getting close to a term sheet from another firm, we reached out to Realtor. It just so happened, like I shared earlier, that they were also in the background exploring companies to buy in the space. And I mean, within a couple of weeks or days, they had internally, without our knowledge, they had landed on Avail as one of their desired targets. So things worked out. other things that I would say about going through the process, I would say there's really three key things or key takeaways that founders should keep in mind if they're going through that process. Number one is the importance of having everything organized. And what I mean by that is like all of your accounting and finance and tax returns and HR documents and payroll records and you know, all of that stuff has to be really well organized so that when you go through a diligence process, things are easy to track down, easy to find. I think companies, I mean, you should start ideally from day one, keeping that stuff, keeping that all organized. Number two, my number two piece of advice for people going through an M&A deal, I would say get a good attorney. In our experience, we didn't work with a broker, we didn't work with a banker, but we had an incredible M&A attorney that we worked with, and it was important. I mean, I'd have to go look at our final legal bills to get the number of hours, but I spent hours dealing with our attorney, even up until 2 a.m. on the day that the deal closed. I called our attorney at 2 a.m., woke him up and said, look, we're negotiating and fighting over this last bullet point here in the purchase agreement. What do you recommend? And he was there for us through a lot of those. And then really my third piece of advice for a founder going through an M&A process is surround yourself with a small, close circle of people that you can celebrate with, you can shout out, you can shout at them, you can yell at them, you can cry. You know, going through that process is emotionally draining, and you need to have that person that you can open up to. And so we did not, I mean, virtually no one at Avail knew what we were going through. And so I had to keep a straight face day to day and keep running the process. And then I fortunately had my co-founder who I would call and curse at, and I would complain to, and all of those things. And it ultimately helped get me through that process.
That was a lot of absolute value. To recap, get yourself a really good attorney and get yourself some people that are going to support you through the entire journey. To that point, we're wrapping up here with like only a couple minutes left. Do you have any wise words of wisdom, or maybe a past experience that you'd learned from that you think would be valuable for just general entrepreneurs that might be listening in?
Yeah, the last piece of advice or thing that I would really share is something that Graham actually touched on a bit, which is, look, building a company is hard. It's one of the hardest things that any of us will do in our lives. And so I think someone told me once that companies really, really fail for one of two reasons. It's either they run out of money or people give up. And what I would say there is, I think through my journey with Avail is the number one reason that we were able to be successful is we just didn't give up, and we ran through walls. We were persistent as hell, and I think that's the type of mindset that entrepreneurs need to have, and you need to be prepared for that long journey, and just keep working, keep grinding, it's a game of inches, and keep trying to get just a little bit better each day, and you'll end up having a lot of success.
I think of entrepreneurship because in addition to being an investor, I'm actually a partner in a few companies and have started four founded or co-founded 4 companies myself. I think of entrepreneurship a lot like a roller coaster ride. I don't know if you've ever thought that, Ryan, but I find that often the highs and lows get higher and lower and come closer together. Sometimes the worst thing can happen the day after the best thing, or vice versa. I actually just stepped out of a strategy meeting of a company that I'm a partner in that's growing like gangbusters, but our whole meeting all day today, all we've talked about is how do we keep up with the customer demand that we've got, because that's a real problem for us. We're not going to run out of money and nobody's ready to quit. But well, I mean, and it's a services business. We're not huge or anything, but yeah, you know, I mean, it's been an all-day session of just trying to figure out how we can grow enough for our customers. So anyway, but hang in there is what I would say. And yeah, know that it's a roller coaster ride. And if you can have the presence of mind, even when things aren't good, I kind of tell myself sometimes, hey, you know, this is kind of the downside of the roller coaster, but there are good things, and hang in there. That's the way I think about it anyway. I can tell you scary stories too. I mean, it's not all roses. You know that, Ryan.
Giving you a hard time.
Anyway, thanks again, Ryan, for your time. If anybody has any questions for him, you can certainly reach out to him. He offered his email, which is ryan@avail.co. Great guy to get to know, especially if you do anything in the prop tech space. Please use the Avail software if you need to manage any rental properties yourself. And again, thanks for your time, Ryan Coon, and thanks for moderating, Ryan. Sully. So thanks.
Yeah, absolutely. Thank you so much for coming up, Ryan. Really do appreciate it. And I see familiar faces, so definitely make sure to connect with the other awesome Ryan up here on stage and share who you are, what you're doing, and maybe if you learned something really cool. I know I learned a thing or two today. Share a piece of content with the community. Thank you so much again, Ryan.
All right, thank you.
We'll be back with more Funders and Founders programming, of course, at the same time, Thursday at 6 p.m. Eastern. We'll do our happy hour next week, and we do those every other week. And then coming up in 2 weeks, we've got an Ask Me Anything session with a new VC, a relatively new VC, I think, called Sweater VC. And 4 weeks from tonight at the same time, we're going to do an Ask Me Anything with David Beasley from Purple Arch Ventures, part of the Alumni Ventures group. So those are kind of some of our upcoming programming. So super excited about all those. Have a good evening, everybody. Talk soon.
Bye, everybody.